Hello, everybody. We'll just wait a couple of minutes for everyone to join. Cool, let's do it. 1 minute past the hour. Let's kick off. Thank you so much for joining, everyone. Good to see some familiar names. Welcome to Sylvera's Q3 data webinar briefing. We are going to unpack some of the themes that we've seen across the market in the last quarter, but also across 2026. Sylvera has a unique position in the market in that we have extensive project level data through integrating with all the major registries and conducting ratings on over 3,000 projects now. We also have extensive market data, right? So we have a broad pricing data set, we have a market forecasting tool, and combining those two things together, the project data and the market data, kind of gives us a unique ability to look at what's happening in the market and kind of where the trends are being driven. So we're trying to explore the themes in more detail across price, retirements, forecasts. We have Ben Rattenbury, the VP of Policy, joining to discuss some of the policy trends. Aaron Tam is also joining to discuss some of the data trends. So welcome. For those that pre-submitted questions, thank you. The Q&A is still available in the call, so feel free to drop some questions in as we go, and we'll end with a Q&A section at the end. So great, Aaron, if you could go into the next slide. Thank you. So this first graph looks at issuances across quarter-on-quarter trends and retirements quarter-on-quarter. You can see the issuances on the left have really dropped off in H1 of this year. We would attribute that to a couple of things. First of all, there's a proliferation of new methodologies and updates to existing methodologies, which has meant that project developers are faced with the administrative burden and decision of having to transition to these new methodologies. That delays issuances, and I think we're seeing that in the numbers. In addition to that, the well-documented bottlenecks that exist at the registry level, I think, continue to mean that fewer credits are hitting the market. There is one exception with that graph on the left, which is the super pollutant category. So it's tagged here as fugitive and industrial gases. So you can think of kind of HFC, destruction, N2O abatement, kind of the broader super pollutant category that has actually increased issuances from Q1 to Q2. That is perhaps attributable to the fact that they were one of the first segments of the market to get CCP labeling, and that may have accelerated new credits hitting the market. On the right, you can see credit retirements, again, quarter-on-quarter. There has been a noticeable drop in retirements in Q2 relative to Q1. However, if you look back at the 2025 figures for the same quarters, you can see a corresponding drop. So it's not unusual that the year starts with a higher retirement volume than the middle of the year. And indeed, we would expect Q3 to be slightly lower than 2026 of the Q2 numbers for 2026, although they're likely to be higher than the 2025 Q3 numbers. So we'll check back on that in the next briefing. So issuance is down quite significantly, retirements marginally down, but that is not unexpected. If we go to the next slide, please. The CCP label continues to increase in adoption. This graph is showing issuances on the left of CCP labeled credits and retirements on the right of CCP labeled credits. You can see quite a marked increase in the share of credits that are hitting the market with a CCP label. Retirements are a lagging indicator. We would expect that 9% to increase as we look at this data through the year. Not really unsurprising. I think the CCP labels have been like slow in their rollout. As the tagging kind of picks up momentum, we will see a kind of a greater share of these green figures here. I think what is more interesting, we go to the next slide, Aaron, is what you see when you cut the CCP label credits by the rating grade. So you're looking at here a graph that shows on the left the distribution of Sylvera rating for CCP labeled credits, and on the right the distribution of ratings by non-CCP labeled credits. The kind of story here is that CCP label credits are 2 times as likely to rate BBB or above, which I think is kind of fascinating. I think the critical thing that jumps out to me, at least when I see this graph, is that on the left there's a very, very, very low percentage of D and C rated credits that have the CCP label, and there's a distribution, as you would expect, quality existing at the project level above that level. But what the CCP label is doing is it's really raising the floor of quality in the market, and it's excluding those credits that are clearly lower quality. Aaron, the median here is BB on CCP labeled and B on those without CCP label. Would you kind of expect this trend to persist? Would you imagine that over time that median in the CCP label increases? Do you have any thoughts on this?
That's a great question. I think overall, CCP is effectively selecting methodologies and implementations of projects that avoid certain kinds of risks, which Sylvera identified on a project-by-project basis. That means over time, when more and more products coming to the market adopt these newer methodologies, which are also CCP labeled, we expect basically the share of high-quality projects to increase over time. And that means I do expect progressively more projects on the left-hand side being CCP labeled, and a larger share of that will move towards the right, which is, say, hopefully a smaller share of B-rated projects and more so to the right, maybe BBB or above.
And the other thing that I notice when I'm looking at this, Aaron, is that the share of A and AA rated credits is smaller for non-CCP labeled credits. Is there any thesis on why that might be the case?
Yeah, that's a great observation. CCP is continuously reviewing more and more methodologies. So there are certain sort of projects out there that are not yet reviewed by CCP, or certain methodologies are not yet reviewed by CCP, but that could come through and that might change the picture a little bit. But I would have to emphasize that there are, dozens of projects that we think at Sylvera, after looking through their project documents and independently verifying the baselines, they are high quality projects, like the A and the AA A's on the right hand side of this chart. It is important not to discount the fact that outside of CCP label methodologies, there are high quality projects that are worth supporting as well.
Yeah, thanks so much. I think the CCP label is doing a great job at what is intended to do, which is raise the overall quality floor in the market. As you can see here, there will still be a distribution at the project level in quality, whether they have a CCP label or not. And you can see that here. But it is great to see that the median is higher than those without a CCP label. So it's a really good indicator that I think a lot of the buyers are beginning to use to kind of shortlist and exclude credits that kind of don't meet that CCP threshold. and we'll keep tracking this, is still being rolled out. The data is still, the trends, I'd say, are still being established. So we'll keep tracking this and keep reporting back on how we see quality evolving with the CCP label. Aaron, if we go to the next slide. So sticking on the kind of supply side, a significant development this quarter was around Indonesian supply. So Indonesia had a moratorium on all credit exports that has been in place since 2022. The Indonesian government created this their own domestic registry called the SVN, which was really with the intention of allowing or giving the best chance for the domestic companies within Indonesia to meet their domestic compliance ETS obligations. So the government really is trying to control the export of credits by doing this domestic registry. This quarter, that moratorium was released. So there was a kind of pent up pool of issuances since 2022 that has begun arriving onto the market. Katingan is the largest of those pent up issuances. They've already issued 10.6 million credits in July across vintages 2021 and 2023. The project's permitted to issue up to 17 million. So there's still meaningful supplies yet to come on from what is kind of one of the flagship projects in the market. So this is super interesting in indicating how host governments are beginning to think more structurally around the export of carbon and how they're meeting their own obligations. It's also interesting from the perspective of the supply-demand balance and how that changes. It is also linked to corresponding adjustments. Ben, our VP policy, is on the call. I wonder, Ben, if you could come in and just briefly voice over why this is significant in the context of corresponding adjustments, NDCs, and whether we think this pattern will repeat elsewhere.
Thanks a lot, Rory. Yes, the domestic compliance markets, which are being put in place in the major host countries, particularly Indonesia, which has resolved this before the others, but also Brazil and India, for example, that's tied to their restrictions on exporting ITMOs, in particular Article 6 credits, because they want to use that domestic mitigation, that low-cost mitigation, whether that's nature-based in Brazil or maybe it's industrial in India. They want to use that first and foremost to support their domestic industries to be able to comply with their compliance requirements, whether that's ETS or a carbon tax or something similar. So this speaks to not wanting to export credits for Article 6 use or NDC use by other countries, because that would require corresponding adjustment, and it means it cannot be counted by the host country. However, selling credits to voluntary buyers means that you do not have to, as the host country, issue the corresponding adjustment. So it doesn't actually hurt in the same way. It doesn't make it harder for you to achieve your own domestic goals, because you can still claim that mitigation towards your national goals, even though a company is able to make a voluntary carbon market claim in another country. So this is something that's caused a bit of confusion. There have been suggestions that maybe even all VCM purchases should come with a corresponding adjustment, so that you don't have double counting between governments on the one hand and companies on the other. But the momentum seems to now be towards companies not requiring corresponding adjustment for VCM purchases. And this is a position that's been set out recently by the Coalition to Grow Carbon Markets, a group of 14 governments promoting demand in VCM. So I think that the clarity is slowly emerging here, but it has caused confusion for quite a few years, this question. Back to you.
Thank you very much, Ben. I can't see the slides anymore. I wonder whether Aaron, there you go, we're back. The screen went black. I don't know if I was axed from the webinar altogether, or that was a problem, but I think we're back. And thanks, Ben, that was super insightful. Aaron, if we could go to the next slide, which is looking at the offtake market. So this graph excludes Microsoft from the figures, and the story here is the agreed offtake volumes have increased in 2026, however, have almost halved from Q1's numbers. However, again, as we looked at the retirement numbers earlier on in the webinar, if you look back at 2025, that drop from Q1 to Q2 does seem to reflect a procurement window, a period of activity that corporates tend to go into the market. It seems to be Q1 and Q4. Q2 and Q3 are consistently down periods. However, if we take H1, first half of this year, in aggregate, you can see actually the volume of offtakes is growing year on year. Aaron, I don't know if you had anything to say on kind of seasonality here, or the offtake market in general.
Yeah, for sure. In general, we see seasonality amongst large corporates, especially on Q1 and Q4, where there's a spike in activity. This is quite clear on this slide, where if you look at 2025, Q1 and Q4 are higher volumes. I think, having said that, I think the offtakes activity is there's a layer of activity throughout the year as being discussed. It's often that they're announced in Q1, Q4. It's clear around retirements where we have a more exhaustive picture, where there is indeed a ramp up of activities around Q1, Q4 because of company financial reporting schedules. So we expect Q3 to be a relatively a quiet quarter as well on that basis, but I think Q4 will come back. In terms of the overall offtakes activity that we observe, of course, a lot of people mentioned the fact that Microsoft has been the largest buyer by far, at least publicly, especially in the durable CDR space. Now, this chart excludes the activity of Microsoft because we have been receiving a lot of questions around, hey, okay, we know the leader is sort of slowing down a little bit in terms of its activity. It has reached a certain plateau in its purchasing timeline. What does that mean for the rest of the market, and what could other suppliers look forward to? We still see a net growth in the number of buyers active in the offtakes market, whether as durable CDR or the wider offtakes market. However, it's worth mentioning that these buyers are a little bit smaller. So while there's still growing activity, growing on a net basis, Microsoft slowing down does have a sort of short-term impact on the amount of volume we're seeing in offtakes.
Thanks so much. And of course, that will impact certain supply sources more than others, right? So yeah, definitely something to keep an eye on. If we go to the next slide, please, Aaron, which shows the pricing data per project type cut by the Sylvera rating grades. It's kind of been a quite established and consistent correlation between willingness to pay and ratings. And you can see, you see that across the board here. A couple of things that kind of jump out to me when I'm looking at this data is where the jump occurs, like where buyers will pay that meaningful uplift. For ARR, it seems to be between BB and BBB. For IFM, for red, for cook stoves, or definitely for IFM and red, between BB and BBB seems to be kind of the threshold at which clients will pay considerably more. But the story here is that, quite consistently, lower rated credits, B, C, D, are fetching a much lower price than those that are rated well. And yeah, this has been the case for quite some time. We expect this kind of correlation to continue. I should say prices do also vary by many other variables. The impact to community and biodiversity is measured in Sylvera's co-benefit score. We also see quite a clear correlation between the co-benefit score and the average price per ton. Looking at averages is fine, right? But it's average, so it does hide some of the like true drivers of these price uplifts. So maybe Aaron, if you go into the next slide, we have again very good project data, very granular project data, and very granular price information. And combining those two things allows us to kind of inspect under the hood of like what actually are the traits, the characteristics of projects that mean buyers will pay more per ton. And one thing that is quite consistent is actually the activity types. The project subtype matters a lot, so does the region. So we saw the red figures on the previous slide. This unpacks the red into their activities, avoided planned deforestation and unplanned deforestation. And we've cut it by Asia on the left and South America on the right. And you can see here the double B or below ratings are in the lighter shade, and the darker shade is triple B or above. And there's quite a consistent price uplift for APD projects relative to, sorry, AUD projects relative to APD projects. And you see this across the board. An ARR price is a big bucket. Commercial, agroforestry, natural regeneration, all of these activity types tend to correlate with the price more granular, more consistently than just ARR at the top level. Aaron, I don't know if you had anything to say about this kind of price differential at the subtype and different things that correlate with it.
Yeah, I think it's often useful to ask the question why we see these variations. I think this chart kind of shows two extra dimensions beyond the rating, right? So there's a regional variation and there's a project activity subtype variation. I think at the regional level, generally the reason comes down to costs. There is a certain degree of price-based competition between project developers. And the fact that, say, land or labor costs differ across regions could explain part of the reason why prices differ. Now, within the same region and within, say, probably the same quality level, why would prices differ? I think in general, whether as RED Plus projects or AR projects, it falls back down to the fundamental inherent project attributes and how people perceive them in general. Whether we're looking about, say, avoiding plant deforestation, or in the case of ARL, say, agroforestry or natural regeneration. These projects, yes, they are different project types or subtypes, but they also confer a different sort of set of characteristics, say, the way they work with the local communities, the way they had, broader nature or social impacts or benefits. So these are the fundamental reasons why buyers perceive them differently. And if we strip them back a little bit, it's actually revealing what are the things that buyers are willing to pay for. And a lot of times it's about economic impact, it's about broader co-benefits.
Yeah, thanks. A really good observation. By the way, all of this data in this webinar is taken directly from the Sylvera platform. We have a kind of a remarkable degree of flexibility in how users can query all of this underlying data and apply different cuts and compare different cuts. Yeah, this is an excerpt of that data. If you did want to explore more of that, then we'll be really happy to show you. If we go to the next slide, Aaron. So now looking at kind of willingness to pay across the market. So part of our data set across around 40,000 retirement records is being able to estimate the price that the buyer would have paid for the credit that has been retired. And we've mapped that onto this graph. The size of the circle here is the overall spend. Quite small. What I would call out here is that the tech, finance, and services firms are the ones that spend more. Not unexpected, given their reputation, exposure, and frankly budget. What I think is also interesting here is if you squint, you can see kind of the bulk of the market is $10 per ton or less, maybe even $0 to $5 per ton. So the question here is, will these non-tech players, those in the bottom left, will they move up the price curve over time, or will the tech and services firms retire higher volumes? So those are the two things that will change this picture. But I think if you'd plotted this a year ago, it probably would have looked broadly similar in terms of who is spending the most and who is kind of valuing quality, I guess, ultimately in their credits. I'm going to hand now over to Ben. Ben's going to run us through some pretty key policy updates that we've seen over the last quarter and implications for the market, for the CORSIA market, and more. So Ben, over to you.
Thanks a lot, Rory, and thanks for the invitation to be here. So I and then Aaron will say a little bit about the new SBTi Corporate Net Zero Standard version 2, which dropped a few weeks ago and is quite a significant development. And then I'll say a few words about the latest EU proposals on the ETS and what that means for CORSIA and carbon credits more generally. So Aaron, if you could click twice, please. Thank you. So the new SBTi standard, Corporate Net Zero Standard, says a lot about carbon credits, but it doesn't call them carbon credits. So at the very bottom there, you'll see verified mitigation outcomes. This is a new label, a new acronym, but essentially where you see VMOs, that is carbon credits. And they have their own way of defining them, but there's no great surprises or deviations there in the bottom of the screen. So it's all stuff that we're kind of familiar with. So there's 3 different ways in which carbon credits, VMOs, can be used, and they relate to different timeframes. The most immediate one is this idea of ongoing emissions responsibility, OER, which is brand new. It was in the draft that was consulted on at the end of last year, but they made a significant change in the final version, which was to add this middle tier. But essentially, under the OER framework, you've got these 3 different types of claims that you can make: engaged, advanced, or leadership. And you can also choose not to make any of these claims and not to buy carbon credits. But if you choose that, then you have to justify why you're not doing anything. So clearly, the default expectation is that all companies should be doing this, and if not, they should explain why, which is very helpful, we think. In terms of what these labels actually require, engaged just says that you need to mitigate at least 1% of your total scope 1 to 3 emissions in any given year. And as we will see, very few companies currently do this. There's a recommended minimum price per ton of $20, but that's completely optional. So engaged is pretty straightforward, 1% or more of all emissions. Advanced is 100% of scope 1 and 2 emissions, or at least 10% of total emissions, whichever of the two is higher, so including scope 3 if needed. And this can be done via VMOs, verified mitigation outcomes, carbon credits, or a minimum $20 a ton contribution budget, some of which can be spent on carbon credits, but it doesn't have to be spent on carbon credits. So there's the 2 options in order to achieve the advanced status. And then there's a leadership status, which actually differs between category A companies and category B companies. Category A companies are very large companies, so $100 billion a year roughly in annual turnover, or 1,000 employees, or medium-sized companies in richer countries. For those category A companies, it's 100% of all of your emissions, and you have to do that by applying this $80 per ton contribution budget, and then using some or all of that to offset those emissions. And then if there's any money left over, that can go to other kind of worthy causes in the battle against the climate crisis. And they list out what those other options are, investing in R&D and so on. For category B companies, so that's every company in a non-rich country, or smaller companies in richer countries, it's the same threshold as for advanced. So at least 10% of all scope 1 to 3, or all scope 1 and 2, whichever is the higher. So that's the ongoing emissions responsibility, and that's, like I said, the one with the most immediate impact. Aaron, if you could click again, please. We'll then see the next major component, which is what will come in from 2035 onwards, which is this mandatory requirement for category A companies to start buying carbon removals. That starts at 1% of their scope 1 to 3 emissions in 2035, and that rises linearly to 100% of their emissions by their net zero target year no later than 2050, but in some cases it is actually 2035 in very few cases, or 2040. So there's that linear increase from 1% up to 100% of emissions. Of course, over that period, you would expect total emissions to also be decreasing, but still increasing demand for removals there. And also the second point, long-lived GHG matching. Most emissions are going to be these long-lived GHGs, primarily CO2, of course, and so they have to be addressed through long-term removals for at least centuries. This starts at least 10% of the 1%, but that increases also linearly to 100%. So you get this kind of exponential increase in demand for durable removals as both the rising coverage and the long-lived GHG matching requirements kick in. Notable counting is quite straightforward. You can't use credits that you're also applying for ongoing emissions responsibility claim for your mandatory carbon removals. And then NBS being formally endorsed is really key, because there was a lot of uncertainty about whether NBS removals would be allowed or encouraged. But yes, they are very strongly encouraged, keeping in mind that long-lived GHG matching requirement as well. Next bit, please, Aaron. The final part is full neutralization. This is one that we'll all be most familiar with. At the net zero year, all companies have to address all of their residual emissions using long-lived removals. The shared scope 3 point is interesting, because that means that companies in your supply chain can address their emissions directly, and then you don't have to address them as well. So it kind of brings this interesting supply chain dynamics, whereby suppliers that are addressing their emissions could, in theory, be more favorable to upstream corporate buyers who have SBTi targets, because it reduces their own scope 3 emissions headcount later down the line. Final point on corresponding adjustments. This is kind of a tricky one we should keep an eye out for. Currently, companies are not expected to have corresponding adjustments for the credits that they use for their neutralization in the net zero year. However, SBTi said that this is under review. And in V3, in version 3 of the corporate net zero standard, probably coming in 3, 4, 5 years, there is some expectation that maybe this will become a requirement. As suggested a few minutes ago, this would go against the grain of the policy discussions right now, but this is definitely one to keep an eye on. Okay, next slide, please. So this is what the rules say. So now we're going to take a quick look at what companies are doing right now before these rules have kicked in, because this is all 2025 data. This is a scatter plot that Anne pulled together showing companies with SBTi targets that have declared use of carbon credits and retired them in 2025. On the x-axis along the bottom, you can see that each company's total emissions going up to a billion tons a year, potentially. So it's on a logarithmic scale. And then on the y-axis is what proportion of their emissions have they offset. And a few things jump out here. Firstly, most companies that do offset do so for a lot less than 1% of their emissions. So that's what we saw before, that even that minimum OER claim is not going to be achievable on 2025 data, at least, in almost all cases. Companies, of course, with higher emissions offset a low proportion of their emissions, as you would expect, and those on the right-hand side with highest emissions, industrials, materials companies, and a couple of consumer companies. Tech companies in blue, not to be confused with kind of purple and fuchsia, but the tech companies in blue are disproportionately above the dotted line, so they're essentially more likely to be addressing a higher share of their emissions than other companies are. Around 20 companies offset over 10% of their emissions here, including some relatively high emitters. You can see on the right-hand side, in the top right, Lenovo and Microsoft, pretty high emitters and also addressing in or around 10% of their emissions. 5 companies offset around 100% of their emissions, and 2 companies offset well over 100% of their emissions. So that's kind of fascinating, but most companies well below 1%. Aaron has pulled together some scenarios for how the new SBTi standard might impact demand for carbon credits. So let's take a quick look at that. Aaron, over to you.
Thank you, Ben. We often get asked about, what would this SBTi updated guidance mean for the carbon credit market, especially around those who have invested in this market or they're developing projects. So here's a quick look at a few scenarios around companies and how they might demand carbon credits going forward. The table on the left here shows you kind of current number of companies in SBTi, that's 11,000. The combined scope 1, 2, 3 emissions is around 35 billion tons a year. And currently they retire around 20 million tons each year, which means they effectively combine to use carbon credits to address around 0.06% of the total emissions. Now, we could create a few scenarios of how that would evolve, how that 0.06% could evolve. And that's how we come up with sort of three illustrative scenarios A, B, and C, up to 2035. This analysis is published on the Sylvera website, so I will not go through in detail, but I want to emphasize, it is uncertain to what extent companies would align with the engaged, advanced, and leadership status. But even if you assume some relatively conservative figures, say, 1 to 5% of companies aligning with engaged status in terms of the emissions footprint, that could lead to a significant uplift in terms of the amount of carbon credits that they purchase. I should say that these are scenarios. Is this sort of up to your subjective judgment to what extent companies would align with the leadership, advanced, and engaged status? But this is just to say SBTi does have an influence on how these companies approach the climate targets. And if we move towards that direction, even a little bit could generate a large amount of demand. Back to you, Ben.
Thanks, Aaron. So what does all this mean? I won't read all the words here because we're tight on time, but suffice to say, given that the current rate of carbon credit used by SBTi companies is so limited and well below even the kind of minimum threshold that's been set out in this OER framework in particular, it stands to reason that this new standard will only have a positive impact on demand. It's very hard to imagine how this could have a negative impact on demand, given that it's already relatively low. So the question then is how much, and Aaron's scenarios kind of help us to get a sense of the orders of magnitude and the assumptions around that. But in general, this is clearly good news for demand for carbon credits, high integrity carbon credits in particular, and removals, particularly from 2035, obviously. And just to say that we've published a number of blogs on this recently, so the link is there at the bottom. Okay, next slide, please, Aaron. Okay, this is the last one from me. Everyone will be relieved to hear. This is about the recent EU ETS review, and there's some pretty major announcements in there. So just to maybe start at the bottom, because that has the most immediate short-term impact, the key headline was that there were concerns that the EU would propose essentially leaving or supplanting CORSIA as the primary tool to address aviation emissions for European airlines and airlines flying to and from Europe. That did not happen. So huge relief amongst all people involved in CORSIA, because this proposal that they did come out with was very pro CORSIA and actually reduces what had been seen as one of the main risks to CORSIA phase one. Of course, there's only 18 months left until the compliance deadline there. And very good news from a CORSIA perspective that the EU has basically said we fully support and want to align with CORSIA. So that's very good news there. That bottom row. The next one about domestic removals is interesting. Around 250 million tons of allowances to be auctioned off in the next decade. So it's not an immediate impact, but of course we will start to see supply having to ramp up to meet expected demand in that period. So quite significant volumes there. And then that middle row, international credits, is another big one that people have been looking out for. There had been uncertainty around what this volume would be. It's 5% of 1990 emissions, but the EU has specified it's 260 million tons. And that's over the period of 2036 to 2040. So again, it's a few years away. They will start pilot purchases in 2031. And again, this is very significant for Article 6 demand. Even though it doesn't kick in for a few years, the supply will have to start ramping up in order to be able to meet that demand. And then the 2 points on the top row don't have direct implications for carbon credit markets, but they are very significant in terms of the ETS and EU decarbonisation overall. And both of them reflect a kind of a softening of ambition, some would say. Others would say this is just recognising the kind of reality and the pragmatic economic facts on the ground. So free allocations will be applied slightly longer than previously expected, and also the linear reduction factor, which is the rate at which the overall cap of the ETS reduces, that will be softened slightly so that we end up hitting zero, essentially, a removals only market later than previously planned. And with that, I will hand back to Aaron.
Thanks, Ben. I think I'll wrap up this session by commenting a few things about the CORSIA market. Ben, you have already mentioned how the EU ETS had the EU announcement had an effect on the CORSIA market. It's worth recapping how CORSIA prices and market sentiment has evolved in the last sort of 6 to 12 months. As this chart shows, which is displaying ICE contracts for December 2026 and December 2027. From the early months of this year, there has been growing concerns around what the EU would do, both in terms of imposing additional eligibility requirements, and secondly, whether it will expand the scope of the EU ETS, and that might have an implication on the scope of demand in the CORSIA scheme. And that has put pressure on CORSIA prices in the first 6 months of this year. And as Ben said a few weeks ago, the EU has come up with the news around what it will plan to do. So first, it will not impose those additional eligibility requirements in phase 1. That had already immediately improved the market sentiment. And then a couple of days later, on July 17th, it announced its review, as Ben described earlier, which means implementing CORSIA fully through to 2035 with a mechanism to avoid double paying and two carbon pricing mechanisms. So that really resolved a lot of the market concerns and risks around what the EU would do. And with that clarity, the market prices have gone back up to around, say, $13 at least from a futures contract perspective. Project-specific trades might trade a little bit higher than that. Now, with that, is CORSIA ready for, sort of phase 1 compliance? The outstanding question is around supply. And this chart shows you our analysis, at least a month ago, what a potential supply could look like for phase 1. Bearing in mind that phase 1 has a deadline in January 2028, realistically meaning that most airlines will have to buy and retire credits in 2027. In terms of the supply funnel, while the potential ceiling is quite large, the main bottleneck is around which countries will provide the necessary authorizations and corresponding adjustments so that there's enough supply for everyone. We estimate that demand could be close to 200 million, depending on what compliance or implementation scenarios we look at. In terms of credits that are confirmed eligible, there's approximately 40 million today. There could be more issuances. But the main questions are around the green, the yellow, and the orange stacks, for which we have different likelihoods to which the countries will authorize credits. And we have evaluated over 70 countries in terms of their posture towards providing Article 6 authorizations and classified the likelihood to which projects would receive those authorizations so that they could serve the CORSIA market. The summary of it is that there is a fine balance for which I think there could be enough supply. There's a high medium probability of supply that will come through beyond 200 million. And we'll be updating our estimates and publishing them in the coming months as the situation evolves. But it's critical to realize that a lot of countries are making real progress towards that end. Every month we see more and more countries providing clearer guidances around how they authorize when and for what project types. So this is an improving picture over time, and we'll post more updates in the coming months. Thank you.
Thanks so much, Aaron. Thanks so much, Ben. And thanks so much, everybody, for tuning in. Busy quarter. We are going to address some of the questions that were submitted before and during the session. So maybe I can start with a question that is pretty meaty, and I think Ben and Aaron, we might split it into two. So Ben, to begin with, what is your house view on removals in the ETS? And then Aaron, to you as a follow-up, will the cost economics of BECS DACs inhibit a one-to-one entry, leading to a lower supply than the target? So Ben, maybe starting with you on the house view of removals in the ETS.
So yes, removals in the ETS, I think this is also about kind of volume of demand, how much demand we expect for removals. And in the ETS, it's tricky because the project types that have been approved so far, both in the EU ETS and also in the UK ETS, are essentially durable removals. and those credits cost more than the current price of allowances. And so that means they're not particularly attractive. There are some proposals around introducing subsidies to make those credits cheaper. There are also, in theory, there are ideas out there around allowing buyers to purchase fractions of removals credits, but that's not really taken hold yet in the policy debate. So at the moment, we do not expect significant demand for these durable removals in the two major ETSs in Europe, the EU and the UK, because the price is just not really competitive. Allowances would have to get significantly more expensive for the durable credits to be attractive. There's an interesting question around DAC, in particular, direct air capture, because, of course, that's the most expensive removals credit. The only context in which it looks affordable is when you compare it to SAF, sustainable aviation fuel. And there have been quite a few people in the DAC community proposing that instead of mandating SAF, as the EU does, as the UK does, as some other jurisdictions do, there should be an option for airlines to buy traditional jet fuel and then address all of those emissions through direct air capture, through permanent removals. So that would be a significant boost to demand for direct air capture, because again, it looks cheap if you compare it to SAF.
Amazing, thank you, super extensive. Aaron, turning to you on unit economics of BECS, DACs, and whether that's prohibitive.
Yeah, there's actually been a very lively discussion around the unit costs of BECS and DACs and what was assumed in the EU analysis, and that could have contributed to some of the conclusions in the proposal. The general debate is whether the price or the cost of DACs and BECS would fall fast enough to a level that is economically reasonable to fund through the allowances auctions, as Ben described. So around 250 million allowances are scheduled to be auctioned, and that will fund the centralized purchases of domestic removals in the EU. However, at current forecasts around EU ETS prices, that is nowhere near the current price of BECS and DACs. So the main conundrum or the dilemma is effectively, could DACs be cheap enough? Could BECS be cheap enough in the 2030s or the late 2030s? I think there is a concern, and I personally agree, that is a bit of a chicken and egg problem for the CDR industry to scale. Like, for it to achieve those cost reductions that are relatively ambitious, that's assumed in those EU studies, it needs to have some demand and some time to grow and scale. But it doesn't appear that there's enough sort of grounds for it to demonstrate itself in the next 5 to 10 years to achieve those cost reductions. So in terms of centralized purchases of CDR in the 2030s, we still have quite some time to go, and costs will improve over time. But I think that's a real concern, that that cost won't come down fast enough for a one-to-one purchase.
Amazing. And that was one question, meaty. So thank you to whoever posed that. I'm going to go to another live question here, which is around the UK and whether the woodland carbon code credits are likely to go into the ETS. The question comments that cheaper than durable carbon, but there's significant integration challenges. I would say, before I hand over to Ben, anecdotally, we see increasing evidence of buyers having a strong preference for supporting domestic projects and projects that they can kind of touch and feel that are close to them. For UK companies, the UK Woodland Code has therefore been very significant and something that we've been looking into quite closely over the past 6 months. Ben, could you take that question on whether the UK will include woodland carbon code credits, please?
So what I'm hearing is that it's probably yes, and that's because there's obviously different constituencies, different camps that are pro and con this proposal, but the farmers are very powerful, not just in the UK, but in most countries. And also there's this strong kind of leveling up agenda, or I lose track. It comes under different names in the UK every few years, but this idea of spreading money to the regions, to rural areas, all of this kind of plays into this idea that wood and carbon code credits should be supported through the UK ETS. The only reason why I see that could be under significant threat is if the negotiations to link the UK and EU ETSs accelerate under the new government that we have here in the UK, because EU ETS linking was a priority for the previous government that we had until a few weeks ago. And I understand that it's going to remain a priority, particularly now that we have Ed Miliband as Foreign Secretary. So I think that the ETS linking could be the only significant barrier to including wood and carbon code credits in the UK ETS as we potentially link.
Thank you so much, Ben. There's a question here on the forward purchase market, which is how common is it for buyers to commit to an offtake prior to registration, and what quality signals would they require to do so at that stage? Maybe I can take that one. Early stage projects prior to registration are definitely appealing for more sophisticated and mature buyers. The reason they're appealing is because the buyer feels that they can establish a relationship super early with a project and influence the trajectory of that project and ultimately the quality of the credits. There's risk involved in this. Getting involved in such a nascent project is difficult, and not all companies are equipped to really go deep on understanding the risk at this stage. The types of indicators that buyers would look to at that stage is, has the developer done this before? What is the developer track record? Do they have experience of implementing that project type in that region? If there's a feasibility study or a draft PDD in progress, what information does that include? In fact, is the data that they would expect that project at that stage, is it available? If it's not available, why is it not available? There's a lot of benchmarking that goes on at that stage of project. So what peer projects of similar or the same activity type in the same region, how have they performed in the market? Have there been any kind of structural issues with getting them to the market? Have there been any delivery, under delivery issues? For buyers as well, the volume and the scale of expected issuances is important. Does the project have the capacity to kind of scale its activities? Is it a partner that they would like to have a long-term relationship with, insofar as they can meet the volume requirements of that buyer? I would say as well, Sylvera, we conduct pre-issuance ratings of projects at any stage, including pre-registration. The nature of the assessment changes as the project gets more mature and closer to issuance, but we can give an expected rating outcome even at pre-registration. It would be a range, and we'd work with the buyer to make them understand where the risks are and actually what the mitigations are. So what the developer can do to make sure they are closing down those risks and kind of trending towards that higher rating that's laid out in the range. So there's definitely a pathway for buyers to invest in projects pre-registry. There are risks that are of different nature, and you can control them, but it does require kind of detailed analysis of the project itself, but also benchmarks. I hope that's useful. We're running out of time. I wonder whether we do one more question, which I will go to Aaron for. Aaron, insofar as there's enough data, how are credits from newer standards like Equitable Earth, LuxES pricing relative to the established registries and standards? And are buyers accepting them? Could you comment on that?
Yeah. So new standards, they typically come with sort of improved designs when it comes to MRV or other aspects of the methodologies. And that typically comes with more positive buyer recognition, and that is something we hear from anecdotes with our stakeholders as well as the data. So it varies by project type, but generally we do see a price uplift and an easier way for project developers to get their products to the market. And I think buyers typically see them with in a positive light because they understand that the new methodologies have made significant improvements relative to the older ones. And so these new standards are introducing some very constructive, I guess, competition to the market, and that is bringing more kinds of products to the market. And I think some product developers are capitalizing on that opportunity effectively.
Amazing. Thank you. We're going to end it there. Thank you so much, everyone, for attending. Thanks so much for the thoughtful questions. Yeah, as I say, it was a chunky one today. Lots happened in Q2. I hope we did a good job of unpacking it. We're showing data that exists in Sylvera's platform. We're always very happy to dig more into it, give you different cuts of the data, discuss it. So there's a pop-up when you leave this webinar that will appear. Please let us know if you'd like to speak to us, you'd like a demo, or you have any suggestions for future iterations of this webinar. That's really appreciated. Give you 4 minutes back. Thank you so much, and see you next time.